You might have heard the saying in investing that you should sell when others are greedy and buy when others are fearful. That's a contrarian view. But how do you take the contrarian view without proverbially trying to catch the falling knife, without being wrong? Well, there's somebody that we're going to sit down with today that is that contrarian. He has contrarian views, and he is not ashamed to tell us where he thinks things are going. As a matter of fact, he has targets for the S&P 500, for the NASDAQ, for the Dow. We're going to get into what's driving that underneath, where those are going. We're also going to dive into catalysts on gold, silver, what's driving those markets, why they've been dipping, why they're going back up again. What you should be looking at to understand where they're going, and again, what his targets are for gold and silver. We're going to talk about oil. We'll talk about other commodities. We'll talk about the bigger picture, like where things are really going, including over the next couple of years, including the next decade. Are we going to see massive inflation? Are we going to see deflation? Is it going to be a big crash? And so on and so forth. We're going to dig into what he's looking at, why he thinks that, and where things are going. We'll talk about the potential melt up, blow off top scenario, how deep that could go, how long it lasts for, and so many other things. It was a great conversation. Second time I've had David the Contrarian on the channel. You do not want to miss this. Let's go ahead and just jump right into it. Contrarian. He's the Contrarian macro advisor. Somebody that goes against the mainstream. He's got a good voice, and so I love to hear it. So Dave, welcome back to the channel again.
Yeah, glad to be back, Mark. Thank you.
Yeah, thanks, Dave. So yeah, you are Dave the Contrarian. A lot of times, I guess the old saying people probably know is, buy when there's blood in the street, or sell when others are greedy and buy when others are fearful. So I think that's kind of the Contrarian. Kind of tell us about what you do and why you have this Contrarian approach and kind of how that works.
Sure. Yeah, I've been 48 years in the business, and I'd say almost from the get-go, I was Contrarian. Kind of learned pretty early on that the consensus was not necessarily the rewarding side of things. And as I say, contrarian investing really means being very contrary at both extremes. So when the market's near a top, everybody's bullish, and you want to be opposite to that. When the market's near bottom, everybody's pretty bearish, and you want to start looking for opportunities. So in the middle, I'm not so contrarian, and I get a lot of pushback now because I'm talking about a melt up and being bullish, and people go, yeah, you're with everybody else who's been bullish. But it's later on, as we get closer to the end of this, I'll get a lot of pushback for being bearish, and people say, hey, this thing has a long ways to go. So you can't win as a contrarian. You're always kind of on the outside of people, and when you're contrarian, say you're saying something that everybody else agrees with, they want to know where your contrarianism is. So
yeah,
it's a tricky thing. But I would say right now, in the shorter term, you got a lot of people looking for an exit here. People talking about a top, talking about Fed tightening, and so my melt up call is in a lot of ways contrary, even though we're kind of in the ninth inning of a long bull market.
Yeah, that's great. So for everybody listening, I want to dive through several things, and we'll talk about some Fed policy. We're going to talk about inflation, which continues to keep going higher. Maybe the indexes, what's happening there, what we expect to happen. I definitely want to talk about gold, silver, oil, talk about some political changes, things like that. So for everybody, stay tuned for all of that. We'll get David's contrarian view on those things. But to your point, David, jumping back, you are the contrarian. And so to your point, like maybe right now you're kind of in consensus with everybody about this melt up, but I can say that you were calling it even when everybody was very, very bearish. I'm just curious though, before we start diving into those individual topics. So how does it work being contrarian at the ends, as you said, right? So like when everybody's bearish or bullish or bullish or bearish. And so, there maybe a lot of people have heard like never try to catch a falling knife. So how do you be contrarian, but still like not try to catch that falling knife or like wait for that trend to kind of develop?
Sure. Yeah. Just keep in mind, I'm a strategist, so I'm forecasting. So I may be talking about, the S&P going to 4,700 or higher. That doesn't necessarily mean I'm saying to people, you got to stay in or you should be bullish, because I'm not, as a strategist, I can't provide advice. Everybody's got to kind of figure out for themselves how nimble they want to be, how close to the edge they want to get. But as a forecaster, I'm trying to tell you where I think the top is. So it's not necessarily an endorsement of what you do from here. It's more just saying, hey, the top's going to be 4,700 or higher. Yeah, we're at 4,200.
Hey guys, let me just interrupt this interview real quick just to plug the show sponsor, and that is BlockFi. Now, BlockFi is doing amazing things in the Bitcoin finance space. As a matter of fact, they've cracked some really big news by bringing on the ex-CFTC chair, Chris Giancarlo, and they are one of the most transparent, most heavily regulated companies inside the United States, which gives me a lot of trust into what their services are. Now, I've recently did a video talking about how to retire off of Bitcoin, and you can do that by leveraging debt and interest against Bitcoin, and BlockFi is the number one company in the United States, or maybe in the world, to go to and use. They are leading the charge. They're paying interest on your Bitcoin if you park it with them, or you can borrow against it. Now, as I broke down in that video, you can borrow against your Bitcoin. And when you take debt against it, it's not taxable. It's not a taxable event. You can use that debt for anything that you want, including to live off of, to leverage up and buy more, or roll it into another asset. You can do something like I've done recently, like sell some real estate, put that money into Bitcoin. Now, as that Bitcoin price has risen, I'm able to borrow against it and go back and buy the same real estate or something similar. And I still own the Bitcoin, and I also own the new asset as well. Lots of ways you can do this. And BlockFi is the company that I recommend. Down in the description, I have a link that you can click on. If you choose to use that link, you can earn up to $250 in Bitcoin just for using that link. So check out BlockFi now. And that's a good point. So like in a melt up type scenario, when we go back and look at, market rallies across.
Yeah, we're at 4,200.
And that's a good point. So like in a melt up type scenario, when we go back and look at, market rallies across multiple sectors, we can see that most of the growth that comes at that top part of that blow off. But at the same time, it's also the most frothy. So you might see the most turbulent. So I guess to your point, you're like, well, I'm forecasting 4,700, but that doesn't mean there might not be 30% drawdowns like in that stage or something like that, maybe.
Yeah, and more importantly, I think is that volatility can be very, very great at the end because the slope's getting steeper. But also, it's a case of what comes after the top, in my opinion, is going to be very big. So it's a risk reward thing where nobody's going to call this thing perfectly. Nobody's, certainly investors aren't going to be able to get in and get out exactly at the top and then play perfectly unless they're damn lucky. So it really comes down to, you have to figure out for yourself, how close do I want to come to that? We're in a fairly unique time because I think we're at the end of a 39-year bull market, and what I am calling a historic top that may stand for many decades. So that means the other side of this, where I'm calling for a global bust, is very high risk. So even though we're close in time, I think we're going to see the bust before the end of this year. We're going to see a top in the stock market, probably in the next few months. Even though we're close in time, the last leg of this could be certainly in the NASDAQ could be 25% or more. So you're in a kind of a unique time where, yes, time-wise, we're almost at the end, but return-wise, a 25% return is what we normally see over a couple of years. So it's really, people have to kind of figure that out for themselves, how close to the vest they want to be and how much risk they want to take. But understand that, when you're this late in the game, risks are high, returns can be high, but risks are also high, and you just have to balance the two.
Yeah. So if we look at some, first you said it may not return. So the market could blow off, crash, and then not return for a couple decades. That's a pretty big statement, but there's historical precedence to that. So we've seen the markets take 25 years to get back to previous all-time high. We've seen it take 15 years to get back to previous all-time highs. So that's really not that big of a stretch when you go back and look historically. But also looking historically, you can see like the 90s NASDAQ boom, for example. I mean, that shot up 100% in the last 12 months, I think, something like that, or 200% in the last 18 months. So 25% isn't that big considering some of those historical numbers.
Yeah, except that we've come from March of 2020, so we're already up 100% plus in the NASDAQ. So that extra 25 is from that bottom is pretty steep. And it could exceed my numbers for sure. The other side of this, where I say it's not going to return to the highs, that doesn't mean there won't be opportunities after the bust, after the bear market. We'll have a cyclical bull market following the bear market. It's just that it won't be back to higher highs. And as you know, there's a mantra out there of, stay invested because markets always go to new highs. Well,
Right.
That may not be true in the next couple decades.
Yeah. And looking back at that historically, I just don't know why you would want to sit through an 80% drawdown that takes 25 years to get back to its previous all-time high.
Exactly.
I mean, most people, even younger people, can't afford that. I mean, 80% drawdown. I mean, historically, it shows that, right? 80% drawdown that takes 25 years. Just no, thank you. Not for me.
Yeah. Keep in mind that we haven't had in the post-World War II era, which is, the last 70 or 80 years, we haven't had more, I think the 2008-9 66% drawdown was 60, the biggest we've had. So the last time we had an 80% drawdown was 1929. So there's a lot of people who say that's not going to happen. That's almost unprecedented. I just think we're at extremes here where I think that's the setup, where that's the risk, is that we're going to see a 70 to 80% decline.
Yeah. Now, before we get into the, indexes and commodities and things like that, which we will, it seems like the catalyst has been, I mean, it seems pretty apparent. I wonder if you agree, but has been obviously the Fed policy, right? I mean, they've $8 trillion been injected in the last 12 months or whatever. And in addition, trillions of dollars more coming, for infrastructure projects. And it seems to me there's no sign of stopping this. And it seems like we've really shifted from like 2008, which it seems like was kind of reactionary, like, oh, shoot, the market's dropped, let's go ahead and start injecting money, to where now they're like preemptively injecting money. And so it seems like that's been driving it. Is that what you're seeing as the catalyst for all these things? And if so, like, I mean, how does that end up stopping? Are they going to stop injecting money?
For sure. If you look, if you superimpose the market on a chart of fiscal and monetary policy, the correlation is very strong. Since March 2020, there's no doubt that the driving element has been, monetary policy in particular, and coupled with the relief spending that we've seen in response to the pandemic. So for sure, it's that's driving things. But keep in mind, monetary policy then leads to something real, and so we're getting real changes in earnings, dramatic increase in earnings, real change in GDP. We're probably going to see the biggest GDP year that we've had since, for decades. So
is that the biggest growth change in GDP?
Yeah. Nominal GDP. Yeah.
Right.
And real, probably, because inflation's still pretty low. So those are real elements. I mean, people aren't just buying air, and money's just sloshing around, and they just go out and buy something that doesn't make sense. So there is some logic to it. The problem is that I don't believe that can go on forever, or that it can go on for a lot longer, because I think we're starting to see the downside of printing so much money is inflation. And although we haven't in the last 30, 40 years had real problems with inflation, it's starting to break out here from long-term downtrends. And the Fed is going to have their hands full, I think, as we move through this year. That's really the race here, is between the fundamental improvements that are coming as a response to in response to the monetary and fiscal policy, and the inflation that's going to cause, that's going to ultimately, I think, tie the Fed's hands, force them to have to tighten. And the one thing that you can be sure of is, if they do tighten, this market's up on stilts, and it will respond negatively to that.
Yeah. I want to dig into that a little bit more, but maybe we're gonna come back to that, because the Fed maybe has some other tools that they can use to control inflation. And we'll come back to that. But before we do that, let's just jump into a couple of things that you've been tweeting about and talking about. So follow David on Twitter if you're not already. He throws a lot of this stuff out there. We'll make sure to link to it down below. But some of the things. So if we jump into stocks, so we have the main three big stock indexes. You've been saying that they're kind of in this consolidation pattern, which they kind of seem to be if you're looking at them. But you think the tech stocks, the growth stocks, et cetera, are still poised to make another run. So maybe they're consolidating, building up energy, and getting ready for that next run. Is that what you're seeing? And if so, why?
Yeah, absolutely. I think if you look at particularly the FANGs, which were obviously the real driving part of last year's run, they pretty much have gone sideways since the beginning of the year. And you're just beginning to see them lift out of that consolidation. They haven't broken out to new highs in most cases, but they are. They've gone sideways, and I think that consolidation is pretty well over. What happens is you have a big run, and then you consolidate. You can either correct with big downside, or you can correct sideways for a period of time, correct overboughts, correct kind of the exuberance that's everybody thinks they figured out. They want to own those stocks. Once they become non-performers, people start changing their mind on them, and that gives you another chance to have another leg up. And that's what I think we're on the verge of, is that the FANGs, the tech stocks, NASDAQ, all have kind of been in a few month consolidation, in FANG's case longer than that. And I think they're beginning to show signs that they're going to break out in the next month and have another leg up. So I think there's, what you normally see is that the things that got you there, the leadership that got you through this bull cycle, typically goes right to the end. And I think tech is going to lead right into the end. So you've had a lot of people in the last several months, and particularly the last month or two, calling the end of FANG and the end of NASDAQ and the end of tech, saying, they've had their day, now they're going to get hit hard. And I disagree. I think there's one more leg up in those before you get there. And then they will be hit hard in the bear market, but we're just not there yet.
It seemed like the tech stocks really started to stumble when the rates started ticking back up again. And maybe because tech stocks are so, debt dependent, they need debt to continue to grow. And it seemed like maybe that was causing them to start to stumble. Do you see that? Is that something that you're looking at and trying to compare against? And then,
yeah, I actually don't think it's that so much. And in fact, many of the big tech stocks don't have, they have pristine balance sheets. It's lots of other sectors that have much more debt on their balance sheet. So it's not so much that as it is that tech tends to be dominated by growth stocks. So with growth stocks, you're paying for long-term growth. And if rates go up, you capitalize that growth at ever higher rates. Means you're going to penalize your returns. So when rates go up, it tends to hurt growth stocks, whereas cyclical stocks, because rates are going up, because inflation is going up, cyclical stocks benefit from inflation pushing up returns. So it really was more a case of, the bond market got hit, interest rates went up. We saw the 10-year go from 0.6 to 1.75 in a matter of months.
Yep.
And you can pretty much correlate that to when the FANGs in particular, but tech in general, kind of started losing performance. And now, you get up to 175. I think, alone or pretty close to alone in calling for rates to turn back down and calling for a 120 on the 10-year. We're about halfway through that move. And it's not coincidental that, tech started lifting their returns again, or outperforming again in the last month as rates came down. So I think that continues here over the next month or two.
Yeah. So the rates kind of continue to slide down, and then the tech stocks continue to slide back up again.
Yep.
Yeah. So, the NASDAQ was kind of known as the tech index, but now it seems like even the S&P is made up and kind of dominated by tech stocks as well. So, I guess then if you're looking at the tech growth stocks, I mean, both of those indexes are kind of driven by those two asset classes or whatever. Then that's why you consider or think those will continue higher. And if so, what are the kind of targets you're seeing there?
Yeah, my target on NASDAQ is 17,000. So I think we're almost to the old highs here. Selling off a little bit today, but we're not far off the old high of where we were a couple months ago. And so you're looking at probably close to 25% upside from here. The S&P, I'm looking for 4,700, and I've said before, it would not shock me to see 5,000. So from here, it's probably 15%, but it could easily exceed that. You could see it up 20%. And the Dow will participate. There's certainly tech in the Dow, but I'd also say, as much as I think tech is resuming leadership, it doesn't mean the cyclicals are now all of a sudden going to rotate out of favor. They've been consolidating for the last month, but I think they're likely to participate in the upside, just not quite as much as the the FANGs and the semiconductors and things like that. So I think we're going to see a fairly broad rally right into the top. It's going to be a lot of groups. I think financials will probably lag because rates are coming down, and I've been fighting energy, as you know, saying that they're due for a pullback here, and they keep going higher. Yeah. So they may not pull back, but it looks to me like they're overdue for a pullback. They've had a nice run here from high 50s to over 70. So oil has. So I would expect energy to probably lag a bit here too. Not that they can't go up, but they won't go up as much.
Yeah. So if we jump sectors, but staying on that trend, which is, you talked about the 10-year dropping, going up from 0.6 to 1.75 and then coming back down to 1.20. It also seems that corresponded exactly with gold's drop, right? So as soon as the gold, as the rates started going up, gold started dropping down. And really it looked like it was maybe a combination of the real rates, right? So the rates minus the inflation. Is that kind of the numbers that you're looking at for gold? And if so, like, what are you seeing there with gold? I know you're predicting gold and silver to still make another really good run higher. Are those the things that you're looking at, or what else?
Yeah, I think certainly rates have shown themselves to be a big factor in the metals, and particularly in gold. Unfortunately, I think, or it's just reality, the algos do an awful lot in the macro space. And if they have a certain relationship that they think is important, it's gonna play. So they've had it almost as a knee-jerk relationship that rates go up, gold goes down. Rates go down, gold goes up. So I think that's why it's corresponded so much. It's not always that tight a correlation, but with the algos out there having the money they push around, I think that's part of what this is. I think as we move here, certainly to move down to 120 on the 10-year and probably 190, 195 on the 30-year should help gold and silver. So we'll get a big part of the lift, I think, towards, my target on gold is 2,500. So it's a big move from here, and silver maybe 45 or 50. It won't all happen before we get to 120 on the 10-year. I think, though, that once you get a pretty significant move from here, then momentum kicks in. So it becomes not just interest rates; it becomes inflation's moving back up. Just the tape is pushing things. So I think people who think it's all rates are going to be surprised, because I don't think it's all interest rates.
Yeah, I think it's pretty evident to anybody who's paying attention at all that all these markets are so heavily manipulated. But it just seems like the gold and silver market, just to me, seems like the most manipulated overall, not only because of the giant paper market versus physical, also the amount of spoofing and things that happen, but the LBMA setting the price of gold on a phone call every day as well. How do you think those factors really play into that price of gold and silver moving?
Yeah, I'm not one that that pushes the manipulation narrative. Spoofing is really dealing with pennies. I mean, it's the day-to-day stuff, but it's not what impacts whether gold goes up or down, in its big moves. I It's certainly manipulation is part of markets. If you want to talk about trading desks doing things and, trying to play what they see as edges and things. But I think people think manipulation, meaning the Fed's manipulating it or the banks are manipulating because they're short gold or what have you. I'm not such a big believer in that, partly because we saw gold go from $250 in 2001 to $1,900 in 2011, so in a decade's time. And during that time, there was a lot of, banks with the same positions they have now or in the same situations. So where was the manipulation holding gold down then? I just think it's an easy thing to argue, partly because of expectations on the part of investors. There's so many investors out there that want to believe in gold and want to believe that gold's going to take off and, think that all this money printing is going to lead to hyperinflation, et cetera, that when gold doesn't move as fast as they think it should, all of a sudden they got to find something, what's going on here that's not real. So I think manipulation is way overstated. It's not that it doesn't happen or that it's not having an influence there. I also think we underestimate, because there is so much retail interest and interest in general in the metals, they get overbought very quickly. The minute they lift their head, everybody runs in. And I think a lot of the movement where they disappoint people without, with the fact that they get cut short is because there is so much speculation in them, people wanting them to go fast. So on Twitter, you'll see me say, markets move when they're ready, not when you're ready.
Right.
It's not always what you think it should do. It's markets have lots of factors involved.
Hey, sorry to interrupt this video just one more time. I'm not running Google ads, so it's actually way less interruption than I normally would have on a video. And that's because it's sponsored by BlockFi. They are opening up the world of Bitcoin and financial products, offering to pay you interest on your Bitcoin, better than owning a rental property that you have to manage and control and have the risks. You can just earn interest on it, or you can leverage against it. Now, I plan to hold my Bitcoin forever and literally never sell my Bitcoin. So how do you do that? Well, if I need money, I don't want to sell that Bitcoin. I'm going to pay tax on it. All right. I'm going to end up with less, and I don't have the Bitcoin anymore. So a better way to do it is to borrow against the Bitcoin. So I've put all my money into Bitcoin. If I want to buy a car or I want to buy a house, I can borrow against it at very, very low competitive rates, get my house, get my car, whatever that may be, and get to keep the Bitcoin. Now, I've done a whole video on this. You can find it. I'll link it down in the description below, how to retire off of Bitcoin without paying taxes. And you can do that with BlockFi services. I'll link to the video down below. I'm also going to put a link to BlockFi. If you choose to click on that link to check them out, you can earn up to $250 in free Bitcoin just for using that link. And that's it. Let's go ahead and get back to the interview. Yeah. You mentioned the 2008. So, gold crashed along with stocks. I think what got down to 1450 or 1500-ish or something like that. But it recovered really quickly. I think it took 6-7 months to get back to its previous high, as stocks took 6-7 years. But that seemed like it was a response to, the $700 billion TARP bailout, and then the QE that resumed after that. And we saw maybe just, 1 or 2 trillion pushed it from 1500 to 1900. Now we have 8 trillion. And so we're not even able to get past to the high we set in 2011 with $1 or $2 trillion printed. I mean, if gold was ever going to work, it should work now, right?
Yeah, I want to correct one thing. The balance sheet's really only grown. You lose track of numbers, but we're up to 8 trillion. It started in March 2020 at wherever we were, 3.5 trillion. So it's not up 8 trillion. It's up 4 trillion probably.
That's a blend of fiscal and monetary.
Oh, okay. Yeah, but I think that money is going to have influence. I mean, it's certainly what's driving the inflation with a lag. And I do think we have more than transitory inflation here. So that's my story in terms of the bust, is that I think inflation does become a real problem later this year. And so a lot of this is also the lags. Monetary policy needs to move through to a point where it does drive the inflation. And we're getting to that inflection point, I think, where it's going to become problematic, probably by the end of the summer.
Yeah. So inflation is not transitory. Inflation
I
is
don't
here.
think so.
Yeah.
There's some of it is. I mean, for sure, the Fed's not just pushing out a narrative to give them room to print. I think there really is some that is supply chain oriented and can go away once things get cleared up. We really had a situation where for many years the industrial side of the economy worldwide was not the driving element, it was the consumer. And here in the last year and a half, with all the money that's been printed, not just by the Fed but by central banks around the world and everything going on in Europe and China and the US and Canada, Australia, etc., it's all come together to push out this huge demand for materials. And yet the materials companies had kind of ratcheted down their capacity because they never thought they were going to see that kind of demand again. So We've had this big ramp up in demand, and the companies are just not able to produce to meet that demand. That ramp up will at some point slow down, and they can catch up somewhat. So that part of it is transitory, but ultimately, you can label it transitory or whatever they want to. If inflation really starts to heat up even more by fall, I don't think Fed can just say, "Hey, we're just going to bank on our faith that it's transitory." I think they're going to have to react, which means tightening.
Okay. So let's add a little flavor onto this for a minute. So I know, we talk about finance stuff, and I get comments a lot if I dip into this, but like, I listen to you for finance. I don't want to listen to you about politics. But you can't really understand one without the other, right? Because it's the political initiatives that go in that seem to drive this. And so we can see there's obviously like these political changes that are happening. And so we can see there's this shift to moving to more UBI. So we can see there's a shift of, the political movement kind of going to one side. So we're seeing, more ESG narratives that are, wanting to kind of control and capture the way businesses work. And at the same time, a shift to, more UBI money printing, more infrastructure printing, stuff like that. And then, so I'm curious how you look at those to affect your outlooks on things. So for example, in the United States and most of the developed world, there's this huge push to move to renewable cars, right? No more ICE combustion engines. We want to move to renewables. So how does that affect oil? Your outlook on oil, I should say, and then also other assets, or I should say commodities like lithium or cobalt and things like that. Do you take those things into consideration?
Yes, definitely. I mean, but my feeling is on oil that you have policy out there pushing a certain view. It's not realistic in terms of their time frame of when you're going to be able to produce enough energy from alternatives, et cetera, to meet the demand. So that means oil's not going away anytime soon. And in fact, because your policy is also trying to limit carbon fuels because you think they're evil or what have you, or polluting, you're going to run into a situation where we're not going to have we're going to have a tight supply demand situation. And as a result, it's going to, the thing that gives when you have a very tight supply demand situation is price. So that's part of my forecast out probably in 26, 27 is that we'll see $300 plus oil.
And that's because they've restricted the supply artificially by shutting it down, but the demand hasn't really gone away.
And the demand, because we're going to see, and I'm jumping ahead, but if we have a global bust, which I am forecasting, and I define a bust as something that's almost in many respects like a depression, but happens at the speed of a recession. If we have a global bust, you're going to see a response from monetary and fiscal authorities that's many times what we've seen in the last year and a half. So many times. That's a huge statement. I mean, we've seen something here that we've never seen before. If you then multiply that by several times, that will then spur big demand in the next cycle for, the materials that we're seeing already are in short supply. So the next cycle, I think there's going to be huge, not only supply issue, but a big demand for that oil that's going to, lead to something we've never seen to the degree we're going to see it in terms of a tight supply demand.
Yeah.
So yes, ESG plays a role in that, because I think frankly, I just think they're unrealistic about their expectations, and it's only going to exacerbate what's coming. What we would have, pretty big moves in all the commodities, no matter what. But I think ESG just exacerbates it.
Yeah, well, I would agree with that statement that it's unrealistic. It doesn't seem to stop them. So from my previous state, California, they've shut down the natural gas and the nuclear power plants to move to renewable. Well, the renewable isn't enough, but that doesn't seem to stop them. So now there's rolling blackouts. So even though it's unrealistic and it's proven that it doesn't work, doesn't seem to stop them. I guess we're just okay being without power sometimes.
Yeah, well, look what happened in Texas last winter. I mean, we're making some policy decisions that I think are based on theories and based on hopes rather than based on reality. And as a result, it's going to be, there's going to be some pain as a result of some of these policies that we're making.
Yeah. What about some of this great reset stuff? So by 2030, you'll own nothing, you'll be happy, which of course, that's a big statement by the World Economic Forum. But then back to some of the stuff we're seeing now, maybe some of this stuff is playing out, which is limiting the amount of energy production, the amount of energy you can produce, putting laws into place that limit that, how much energy can be used by businesses and people. And then even maybe some of this stuff where BlackRock's buying up all the single family homes and people can't even buy them now. They have to be renters. I guess that's a longer term view. I mean, is that stuff that you're looking at and thinking about like over a longer term lens?
Yeah, I think it's all going to play out. I mean, I have to say I guess I kind of keep it simple, stupid from the standpoint of I think the global bust is going to be the biggest downturn we've had since the Great Depression. And I think it's going to lead to huge monetary and fiscal response all around the globe. But before we get to that monetary fiscal response, we're going to have a real financial crisis on our hands, bigger than 2008-9. And again, this is global. That then leads to the response, which then with a lag leads to another recovery cycle, but one with an entirely different focus, because it's going to be pushed by fiscal spending, which means it's going to be infrastructure driven, and again, not just in the US but across the globe. So you're going to get into all of that, and I understand the view of a reset and that we're going to collapse here and they're going to change to a different reserve currency or basket of currencies, et cetera. I just think it's premature to be expecting that now. I think the real time, the D-Day for when all this stuff kind of comes to a head is probably out late this decade, early next decade, when you have, as a result of a bust leading to much more policy expansion, meaning that you can have inflation going probably all the way back to where we were in the early 80s, meaning 15 to 20% inflation, 15% plus interest rates. And that's going to come in direct conflict with the need to finance all this debt that's being flooded on the system. I don't know how that happens. So I think it leads to a collapse. So I think the reset is forced upon us, not by the IMF, and it's not going to be just a US situation. I think the risk is that when we get to the 2030s, we're looking at a total worldwide economic collapse and financial collapse. And what comes out of that, my fear is that totalitarianism, but it's not this. I can tell you, I am not in the camp. I think it's silly, this idea that the sooner we have this collapse, the better, because then we can reset and go merrily on our way. not going to how it's going to happen.
Right.
We are really in a crisis period for this country in particular, because we were the economic leader of the world, and that's going to have major impact on the rest of the world. And I really do fear New World Order, in my opinion, is code for a communist takeover of the world, and that seems to be the most likely direction we're going. And frankly, there's a lot of useful idiots in this country that are kind of thinking New World Order is something good, and they're gonna maybe find out it's not what they thought it was.
Yeah, definitely. I agree with that perspective. I think it happens sooner than next decade, but we'll see what that happens. But to your point, about this moving to totalitarianism, and the reason why I think this is important to understand, Mark Carney, head of the BOE, came out a couple of days ago, and he said that a quote climate emergency that threatens life on Earth, he claims, requires rigid controls on personal freedom.
Yep.
That's his quote, right? So it's a climate emergency. So in order to preserve life on Earth, it requires rigid controls on personal freedom. And what would those controls on personal freedom be? Consumption, energy expenditure, things like that, right? So no doubt we're moving that direction because they're telling us we're moving that direction. He said it right here.
The sad part is, and again, I think a lot of people are useful idiots that don't know what they're doing, but I also have to wonder, when you hear it from a Mark Carney who should know better, or lots of our leaders in this country, you got to believe that again, there's a lot of people in on this thing, and I think they're crazy to want this, but you can't explain logically evil, can you?
Right.
I mean, and frankly, that's what I do think. That's what they want. They want to move us towards this one world government that's going to control our lives and do all of that. I don't know why. I don't know why anybody that's seen what we had in America would want to go a different direction. But all I can say is that seems to be the direction we're headed, and some of these people should know better.
Right.
And so, Mark Carney saying that is concerning. Frankly, at this point, given what's happened in what I call super cycle, that I define a super cycle as the big cycle is between two depressions. The last depression being the Great Depression of the 30s, the next depression, I believe, being the 2030s. And so we're in the last decade of a super cycle. In my opinion, this is all pretty much baked in the cake anyway. I am not a fan of the Biden administration or what they're doing. I'm not a fan of climate change, because this redistribution of income is really what its motivation is. And I'm saddened by to see how many people are kind of bamboozled by all that. Yeah. But I think even without them, this is it's so late in the game now, you can't turn back. And earlier on, it wasn't driven by an agenda. Earlier on, it was just a natural process of moving from a system that came out of depression. People knew the lessons they learned in the depression, and you get so far removed from them, and now people think there's a free lunch. Let's have MMT. Let's just print money and spend money, because there's always rates are low and they're always going to be low. Well, no, they aren't.
Yeah. Yeah, I mean, you get to a situation, kind of like what the fourth turning talks about, where you have generations who have never produced. All they do is consume. So they're living off the production of generations before them. So they don't have a real world understanding. But yeah, they're the ones in academia and politics that are making the decisions. And so it's unfortunate, what happens with that. But if we take that and then kind of take a couple steps backwards to where we were, so we'll kind of bring this back to full circle and then we'll wrap it up. But so if we understand that they have this need and to push towards more control, we can see this. I just told you, Mark Carney, I read his quote. They want that. We can see that they're really driving this economy, right? So they want to print this infrastructure. They want to push money for renewables, push money to push this ESG narrative. It's obviously crushing economies all over the world, but no problem. We'll print money for them as well. So it seems like they really want to drive this. Now, you had talked about earlier about that's pushing inflation, but they may need to pull back on that money printer to stave off inflation. But at the same time, if they do, the whole thing could fall apart. So they have other tools like yield curve control, for example, to suppress the rates. It could even go as bad as controlling prices to limit inflation. And we've seen countries already talking about that. We've even seen people in the United States talking about that. So I guess in light of all that, do you think this blow off top as you're projecting, right? This 80% drawdown that could happen, in the next year or something. Is that because they go till they blow, meaning they're full pedal to the metal, printing as much money as they can, and it just stops working, diminishing returns? Or is it that they're like, wow, inflation's way too hot, we need to pull back, and it's more of like self-induced?
Yeah, it's really a case where I think they, keep in mind, is even though we're 40 plus years removed from the hyperinflation of the early 80s, it's been my observation, and I've been in this business since 73, that it was just amazing, decade after decade, what happened to us in the early 80s that I lived through as an investor, was still the conscience that kind of kept things under control for, every cycle. The minute it lifted its head, people said, oh, inflation's coming back. And they got nervous, and then they'd find inflation wasn't coming back. And that, went back till we ratcheted all the way down to pretty much zero. And so now we're at a point that we haven't been at really in the last 40 years, where it's truly breaking out, and it's not a fake out. And it's not one of these things where it was a false call that inflation's a risk here. So but they still have that conscience that they do understand that, boy, we don't want to go back to those early 80 days and early 80s days. And, we went in the late 70s from 6 or 7% inflation, and it was only took 2 to 3 years and we were at 20% inflation. So they realized that if they let the genie out of the bottle, it's not an easy game to get it back in. So I think that does have as much as everybody's worried the Fed's printing too much money, and the Fed's talking about it's still a couple of years before they have to tighten, et cetera. I think in the back of their mind, they know it's closer than that, number one. And number two, whether they know it or not, they're not gonna have a lot of tolerance for inflation pushing, a lot higher. I think if we see, the numbers coming in month by month for the next several, at the levels we've seen recently, they're going to get nervous. So that's first and foremost, that they will, I think, step in and tighten. And I think tightening is going to be probably more from the standpoint of money than interest rates. Everybody, most of the street talks in terms of rates. I look at it as money is much more important. I think they will drain the system of as much as $1 trillion if they feel that inflation is breaking out here and not just transitory. And then you bring in to the equation the fact that we had what we had in the last 15 months in terms of a pandemic that led to a worldwide shutdown of the economy, and where, as much as statistically we're seeing recovery, we still have a lot of landlords not collecting rent. We still have a lot of people not working. We still have, a lot of people who haven't paid their mortgage in a year. You don't just all of a sudden say, okay, the economy's recovered, I'm going to catch up on those 12 months I didn't pay. So you've got a lot of fragility in the system there and everywhere else. So it's a funny situation. It's a really bifurcated situation where we have the potential for an economy that looks like it's the strongest in decades, but really below the surface is the most fragile it's been in a long, long time. So it means it doesn't have the tolerance for cranking down the system, ratcheting down money or raising interest rates that it might have in other cycles. It means, I think, the Fed is going to find that the response to their tightening with a very short lag is going to be a lot larger than they anticipated. And I think we're going to, and again, I talk about the Fed, but it's really central banks around the world are going to be in the same position. I think we're having a situation where the unwind is going to hit us so fast, and all the policymakers are going to be deer in headlights going, what do we do? They did a good job of responding to March of 2020, but this time around, I think they're gonna be going, what can we do now? We've already printed all that money. We've already done all this, fiscal stimulus. We got to be careful. We can't just do that again, but they're going to end up having to. It's just going to take them a little time to realize that they don't have a choice.
Yep.
And by the way, I always say the difference between me and some of the guys out there that are the guys that think we're on the way down now. This is the big one. The Peter Schiffs of the world. The difference between those guys and me is that I do say there's one more recovery cycle. And the reason I can say that, and I've been saying it for a number of years, is in deflation, and that's what the global bust will be, a global deflationary bust. We'll go from this inflation concern to very quickly the first deflationary downturn, I think, since the Great Depression, widespread deflation. So in deflation, central banks have almost infinite ability to print money. If this were a case where we had inflation, their hands would be more tied. Because more money means more fuel on the fire, more inflation. But if you're in deflation, the leads and lags to when that money brings you back to inflation and a problematic inflation is long enough that they're going to be able to say, we got to deal with the here and now. We've got on our hands right now major bank failures around the world. We have involuntary debt liquidation across the globe. We can't worry about inflation right now. We've got to worry about deflation. So that's why that money will then beget one more recovery cycle. Where you run into the problem is that one more recovery cycle then gives you hyperinflation. And you will have, unlike the 1980s, you'll have hyperinflation with perhaps $400 trillion of debt. And, right now we're over 250. By the time we get done with this bust, we could be up at 350 to 400.
Wow.
You can't. I mean, there's no equation you can come up with to tell me how you solve that. Right. It just leads to a Ponzi scheme that just collapses.
Yeah. Wow. Those are big numbers. That's a big picture. And I guess with that, we could go ahead and wrap it up. That's we're going to something like that. We know they're going to keep printing, and whether they go till they blow or they try to pull back and then try to step back on the gas again. Unfortunately, there's only really one outcome of this. It seems like a deleveraging. So
the difference between one scenario and the other is a matter of 5 or 7 years. It's not like one is go merrily along and the other one is, oh no, we're in trouble. We end up in a bad place either way.
Yeah. I would imagine you said you started your career in 1973. So that's just 2 years after we started this whole, fiat money system. I mean, whatever, you could argue it started earlier, but really that's, when we got off the gold standard. And so look how far we've come in 50 years. And so like to say that we could even go another 5 or 7 seems like way too long. If we've gone this far in 50, I mean, imagine like where we're going. It's just unsustainable.
Yeah, that's for sure. It is unsustainable.
Yeah. All right, David. Well, that was awesome. Thanks for giving us that contrarian view and really kind of helping us understand kind of where these markets and asset prices are going. Appreciate that. I'm going to make sure, like I said, everyone follow David on Twitter. I'm going to link to his profile down below. Anything else you want to call attention to, David?
No, other than we talked about bonds, just understand that move down to say 120 on the bond market. Obviously, I don't know exactly where it's going, but if I'm pretty right on that, just understand that's not the end of the move up in rates. I do think as the Fed tightens later, you could see 2.5% 10-year before this year is out. So, the move down is just a short-term move. And then I think as we tighten, rates move back up. And that's what becomes problematic for the stock market, along with the fact that they pull money out of the system.
Yeah. Okay, great. Well, thanks for that information, David. And thanks for your time. As always, it's a pleasure talking to you. I love the insights that you bring. And with that, we're going to go wrap it up.
Okay, Mark. Hey, thanks for having me.
All right. Bye.